Hello and welcome to Your Business, Your Wealth. My name is Paul Adams, CEO, founder of Sound Financial Group. I'm joined by Corey Shepard, who you guys are going to see get surprised a little bit today, because while we have a very important topic today, but what we're going to be doing today at the very start is I run a small meme collection, and I grabbed some that I thought that Corey would enjoy. I enjoy a lot of them. I don't save that many of them. I'm like, they're on the internet. I can find them later. So we are going to start today going over memes. But before we do that, let's talk a little bit about the topic of today's episode. We're going to be talking about why you don't move your money, when things are volatile, when things are scary, all that, which we've touched on this topic a bunch. But there's just some great new things out there and some things we're going to look at where it's like the biggest stock prognosticators are saying, here's what to do with your money. And they're not only wrong, but they're wrong real fast. You don't even have to wait very long for them to be real wrong. So with that, that's going to be the topic today. We're going to hit that. It's not going to be a super long episode, but we are going to have some fun with Mr. Corey Shepard. I don't mean fun at his expense, just fun. Fun with fun with his expenses. I don't know how we're going to put this, but here is the first one. Corey?
How to drink decaffeinated coffee. Pour it down the drain. Make real coffee. Drink that instead.
See,
I like that
first one. I knew you would like it. Right? I knew you'd like it. It had to do with coffee, right up your alley. If you guys have never had Corey's home roast, you definitely should. Okay, here's the next one, Corey.
Hello, I just want to know if I'm covered if I hit any wildlife. Insurance agent. Of course, sir. What did you hit? Bob, a trout. And it's a picture of a car or a truck coming out of a lake.
Going in. That is the going in. See
going
that?
In. That is
the tail lights are still on.
Yeah.
He's hitting the brakes, which I think is pretty responsible.
He's leaning on the brakes. That's for some part of him. So to give you a little context about me and memes, all right. Well, Jesus showing me memes from my phone and explaining why I can't go to heaven.
This is absolutely me. If I'm blessed enough to go to heaven, Jesus is going to be sitting down with me. He's going to be like, you really sent these to your wife? I was like, nobody else I could send them to.
I don't think that's true. Based on how many you send me, I feel like you think I'm someone you can send them to.
You should see the ones I send my wife. The ones you get are the tear down.
Not. Wow.
So tell us about memes. I do love Corey's philosophy on memes before we get to our topic at hand today.
Well, when Paul asked me if he could show me some at the beginning of our episode, and I did not see any of those ahead of time, he just asked if we could cover this topic. I did say something like, if I never saw a meme again, I wouldn't be sad. and it's kind of the same that I feel about bumper stickers. Anything worth saying can't really be expressed on a bumper sticker, and a bumper sticker never really expressed anything worth saying. That's kind of what I feel like.
Oh, I like that.
Well, because it's, like some of them they're usually clever in a really bitey kind of way. And it's like, yeah, I get what you're saying, but by being so sarcastic and just kind of mean with that bumper sticker, you're not creating a conversation, you're shutting one down. Like, that's kind of how I feel. Now, memes tend to be more on the purely funny side. You have a little bit more, real estate to work with, but it's not that I never want to see one again. I'm sure I will, because Paul.
I'm in your life.
You're in my life. But it's more that I'm trying not to pursue that, because there's so many things we can get, social media articles that are shorter and shorter. If you're reading news articles that just give us the short term endorphin hit kind of attention span, and I'm trying to get back to long attention span. Like, I remember when you eat, unless there was a bathroom break or a snack that you really needed, you might just sit in front of the TV during a commercial and not do anything else, but just kind of tune out. You may not even be watching the commercial, but now, number one, I don't usually see commercials, but if I'm watching live sports, that's where you really only see commercials anymore. And I might go to my phone. Just if Danielle pauses the TV and walks to get water, I'm picking up my phone within 0.2 seconds to read something. The brain just needs a little bit more time to relax. So take out the tiny things and leave the big ones if possible. That's what I'm trying to do.
I actually, Corey, I really like that. I think it's both brilliant and, of course, frees up your mind to do more productive things every day, and maybe not even productive, but just those things that nurture you, etc. In the meanwhile, I'll be your meme man. I will bring these to you.
Sure of it.
I just want you guys to know that as I find these memes, you should be rest assured that the intellectual capacity of Sound Financial Group is not being compromised, thanks to Corey Shepard. Corey, we're going to start our very robust conversation about why people should stay invested with a tweet turned into a meme. Now, I'm covering up the bottom, and all I have to cover up the bottom is the Jesus meme tweet, so if you guys are watching on YouTube, sorry. Okay. So this is from Jim Cramer. Charts suggest it's not time to buy the dip in mega caps tech stocks just yet. Now, that was published November 7th of 2022.
Now, I want to talk about charts and charting. For those who don't know, there is a school of what's called financial analysis. I'm just going to use the word financial analysis because I don't really have any other word to use for it. That is essentially like reading the tea leaves, is really what it comes down to. Like, what the shape of the chart is suggests the future. And there's some really funky, like, ducktail kind of thing. Like, it goes in, it's almost this. It's almost
like
the zodiac.
See, it's flagging right here, and they draw on top of it. It's like John Madden. John Madden meets Jim Cramer.
Yeah. Yeah, that's
draw
so
on
great.
The chart. You can see here is the bottom tolerance and see the banding, and they get super into it. It's called technical analysis, is the fancy term for it. The guys that do it call it technical analysis. We call it stock Ouija. And fortunately, Corey knows how to spell Ouija, because I don't. Comes out on Monday. Charts suggest it's not time to buy the dip in mega cap stocks just yet. And then Zero Hedge tweeted this. And Friday of the same week, NASDAQ climbs. NASDAQ 100 climbs 9.4% in best two-day gain since 2008. Now, the NASDAQ 100, as you know, are the biggest NASDAQ companies. They are, by definition, the tech mega caps.
Paul, who is Zero Hedge? And this, like, who did you find? What is this, like, shirtless bodybuilder? Look at their...
Okay, I'm going to...
For those of you listening
Corey,
to the audio
it's me.
only...
It's me. Let me just... I'm going to undo my shirt. I want you to see it.
Anyone who's listening audio only, you really got to get the video for this one. That's all I'm gonna say.
Zero Hedge is a well-known Twitter account, makes all kinds of financial stuff, also kind of active trading, etc. Gotcha. I don't know why that's their photo.
That's pretty amazing.
Okay.
So, point is, Kramer's chart seemed to be wrong. Like, if you were trying to time the market and buy into a dip, which is not a good thing to try to do, that would have been the time to do it.
Yes, and that's just it. You guys have heard us talk before about market timing, about is now a good time to get in? Is this the time you should get out? Whether he said don't get in, don't get out, do get in, or do get out, it doesn't matter. He's doing it all based upon some kind of technical analysis, some kind of active stock picking, etc. And he's just one of the loudest examples out there of people that do this. I'm going to go a little off script here, Corey. And I'm going to just...
Would you get me the script? I didn't see the script.
I know, yeah. You're off script all the time because I just keep it all close to the chest. So I got to show you, our audience, this, Corey. There is a guy who has written financial books for a long, long, long time. Hang on, I'm just going to find his author's page so we can go right through him. I figure since we already said something negative about Mr. What's his name? Ramsey last week.
I don't think we're saying anything. Oh, Ramsey last week, yeah. I guess
I don't think we're saying anything. Oh, wait, we did on that guy. So this guy...
And by we...
Probably Paul.
What? Harry Dent.
Harry Dent. So if you get a chance, you should look at this and just look through. You don't even need to buy the books. Just go back and read the preface on each one. The next great bubble boom for 15 years. Oh, that's all about him. And he's been projecting recessions, etc. And all you have to do is just read the little encapsulation of each book on Amazon. And the things he's predicting, you can go back to these other books and already see it didn't work. Because what they need is somebody just to be entertaining enough for people to buy the book, tune in till the next commercial break, and get you to stay engaged with that content. And this is just a great example of somebody who has written books over and over and over again that are wrong over and over and over again, but still gets publishing deals. Why? Because does the book publisher say to an author, does the book publisher say, I need to make sure that your book really, really helps people? Or do they care that it sells 200,000 copies?
200,000. I mean, just think about, someone has to notice a trend, predict it far enough in advance that they can line up with the schedule of a publisher to actually get the book out in some sort of release date, marketing plan that still leaves enough time for everybody else to act on it. It just doesn't make that much sense to me.
I think you're exactly right. And now that takes us to our next little piece of information about why you don't jump your money around to the market. This is my personal Roth IRA year-to-date returns. It's right off our client dashboard. And this is October 2nd. You know, in our entire portfolio of clients, we had one client that broke strategy right here. And they said, we just want to stay out of the market until Valentine's. And I recommended against it every which way I could, just trying to help them see that, you know, if you're worried about some short-term capital, let's just take out the short-term capital. There's no sense in just getting all your money out of the market. But they exited right here. Now, the market was down in an 80-20 academically allocated, globally diversified portfolio, 18.7% for the year. And in like 2 months, even with the recent downturn from yesterday, it's recovered about 10% in 2 months. Yeah. And this is not recovering 10% like when people talk about recovering 10% from a smaller number. This is 10% of the original number.
The original.
So it's actually up, you know, some 12 or something like that to get back to where it is right now.
And to be clear, it's not, number one, Paul, you weren't saying magic's going to happen between now and Valentine's and that's why you've got to do it. It's not that we weren't right about the market going up over these last 2 months because we didn't say that it would. Mm-hmm. It's just that we don't know when it will exactly, except over the long term it will. It's just, let's take it out of the guessing game entirely. I'm sure Kramer's been right sometimes because he makes enough predictions that he's got to be right some of the times,
even by accident.
Right. But we're saying, how can you be right every time and enough times doing that it leaves you better off?
That's it, because it only takes one big mistake to set people back, and no kidding, it could set people back decades in what they've efforted to build and save up to date. And how you correct it when the market goes down, rebalance, stay patient, stay focused on your long-term objectives, arrange the rest of your balance sheet so that you can stay a disciplined investor. And when I say arrange the rest of your balance sheet so you can stay a disciplined investor, that's just have enough cash. Have appropriate amounts of insurance so that those types of events don't cause you to tap it. And you'd be amazed what happens with your money. And I'll give an example. People talk about sometimes setting money aside for retirement as gambling. And I think it is for a lot of people because of how they go about it.
There's a way you can do it that makes it more like gambling. Absolutely.
Yeah, and especially moving money into the market. The way Jim Cramer does it, gambling. But think of it this way. When you go to Vegas, you're going to gamble. Okay? When a casino develops a new property, they don't call it gambling. They call it investing. Why? Well, let's think about a disciplined investor. If, let's say, all you did was invest in the U.S. market and all you bought was the S&P 500, which is not a strategy we recommend
recommended
at
strategy.
all.
but for simplicity's sake, we'll talk about it.
Yeah, you look at the S&P 500 the last 40 years, you could take any day of the year, pick it, and then pick a day 1 year later. It will be higher more than 75% of the time a year later. That, if you were thinking about it like a casino, that's like the blackjack dealer winning versus the blackjack player. And that's the key. That's what we want to make sure we're doing is just, it's fine. You know, I was re-listening to our interview with Scott Adams a couple of years ago, Corey.
Yeah.
And one of the things he talked about is changing your language can keep you from making mistakes. And changing our language to simply say, like, if you want to do some stock trading, do some stock trade. Just don't call it investing because it will fool you. Language is so powerful. Just say you're speculating. I'm going to take $10,000 and speculate. Or I'm going to take $10,000 and gamble. And that way you don't ever get it confused, because you could have a couple good year run with your $10,000 and say you grew it to 40. That's amazing. But that doesn't mean what you want to do is take your 4 million and do that, because you're still speculating. And just like somebody can gamble and be up, they can end up back down in a hurry. But if you're investing, you can do something about it. You can have strategy of how to recover, et cetera, when the market goes down. And Corey, that brings me go ahead.
I was just thinking that a year later, 75% of the time you're higher. That's better odds than the house has on roulette, isn't it? Because the house, it's a little better than 50-50 for the house because of the two greens.
Yep. Well,
the double zero.
It's the zero double zero makes it way better for the casino. If they had just 1 0, then that's their smallest amount of profitability. But it is better than roulette. It's an amazing thing when you can hold the strategy of being a disciplined investor. But what does it take to be a disciplined investor? It takes discipline. Oh, what builds discipline? Knowledge. So if you're not digging into something like this podcast, if you're not looking at the historical returns, if you're not meeting with your advisor to really understand what's happened in the past when people do try to move their money in and out, I mean, the biggest condemnation of why active management doesn't work will not be talked about by the financial industry. And that is because they're selling mostly active management. So how can they tell you you can't possibly outtime the market when they're selling you funds, selling you on the fact that some guy or gal or some amazing hedge fund in a very tall tower in a big city with marble floors and like 8 screens are trading and is somehow outpacing the billions of people in the free market that are exchanging and setting those prices? They can't tell you you can't do it because nobody can. They have to say you can't do it because you don't have the research department. The people with the research departments can't do it. Now, which leads me to an article that we touched on earlier this year that I just wanted to show everybody turned out to be true. Retirement savers seek safe haven within their 401k plans. They may regret it later. And here we are. People are absolutely regretting if they chased money into fixed income. They are putting themselves in the position where they're not likely to get the returns that would be required for them to have a life where they have permanent financial independence. And then I got one more, Corey, that is just a hilarious headline to end us on.
Another meme?
I found this one in a meme, but then I went and got the article. So it's close to a meme.
That was great. Meme adjacent.
I like meme adjacent. That's good. This article identifies as a meme.
It's called a knock knock joke.
All right, Corey. I just want you to read it out loud. Go.
All right. The key to avoiding high mortgage rates: buying homes with cash.
Now, when I saw that as a meme, I thought it was Photoshopped. So I Googled the exact headline and found this originally in the Wall Street Journal. Like, what?
That's like, wait, the key to avoiding increasing gas prices? Sell your car.
Walk. It's like we can put that anything. Like, having a problem with weight gain, put less food in your face. Like,
gee whiz.
Having a difficult time with your car jack, just lift the car. Like, the thing is, everybody who can do this doesn't need the article to tell them they can do this. Now, one fun thing I'm going to point out in this article that I hope I can find quickly. There it is, right at the top. This guy, Mr. Brown, I should say who wrote this. I don't know who wrote it, but to avoid rising rates, Mr. Brown, 56, bought a 3-bedroom home in Littleton, Colorado for $965 in cash. But to access the capital he needed for the purchase, he tapped into his personal savings and took out a loan using his stock holdings as collateral, receiving an adjustable rate based upon the Fed funds rate plus 2.25% margin. On November 7th...
So he got a mortgage.
Yeah. So here's the thing. What he got was a mortgage. If we add 2.25 to 4%, that's 6.25% variable. And if something also happens to your stock portfolio, you had to tap it because of a disability, you ended up with a business opportunity, or the market just went down a lot because you weren't in an academically allocated, globally diversified portfolio. So instead of being down 9% for the year, you're down 30%. And then they do something called a margin call, which just means you need to pay back that money within 24 hours or they liquidate part of your portfolio that's already down. So good job, guys. Like, you got a 6.25% loan, and you could have gotten 7 fixed for 30 years. Now, on the side note, we have helped clients do this. So here's where I'm going to give
there are
some
situations
fun.
where a asset-backed line of credit can be useful.
And this is
but
one.
Not in this context.
I'm making fun of him, but this is a place to use it. He listed what was former Colorado residence, 4,700 square foot, 5 miles from his new house for $1.675 million. Once he sells, he plans to use some of the returns to pay off what he borrowed against his stock portfolio. Now, all in all, super good decision. We've helped clients do this. I just thought what was funny was to avoid rising rates, he did this. It was like, that wasn't avoiding a rising rate situation. That was...
You're still getting a rising rate.
I just wanted to buy a house before my old house sold. That doesn't have anything to do with an interest rate decision. Which just
he could have done all of that without the line of credit if the sell and buy dates were lining up, like lots of people did that. He could have gotten no mortgage. Wow.
Yep. But all that to say, when you're reading, when you're looking, when you're online, take the time to follow the links, to read the thing, to notice, hey, they're wanting me to feel this way about this. But what do the facts say, and what should I do? And then last but not least, and the overriding theme of this is, I promise everybody here, we are going to have more volatility than what we've seen so far. I guarantee it.
Yeah.
Corey's chief compliance officer, sorry, point this way. Corey's chief compliance officer. And I just don't know when it's going to be. And neither does anybody else. So during these times of volatility, we are building our frame. We're building our strength. We're building our constitution. And we're putting ourselves in the position where when the next downturn comes, like, oh, I've done this before. You know, my favorites are meeting with my 60-some-year-old clients who have been investing for a long time. They've been with us for over a decade, some of them. And I checked in with them all this year. Hey, how you doing with everything going on? They're like, like some version of, I've been on this rodeo before. I'm fine. I don't need to worry about it. And that's the thing, is that the going through the pain and realizing it's all okay on the other side, that's the thing you can't get in a book. That's the thing that you have to go through right now. And the biggest blessing for those of you that are in your 30s, the best thing you could do for your tuition to a better financial future is going to be to stay invested right now. And by the way, I would say the same for anybody nearly of any age, because what you will learn by going through this and holding discipline is going to teach you why you hold it in the future. And for that
And
client,
next time it'll be bigger
That's it.
numbers, same percentages, but that's a bigger dollar amount we have to deal with. So learning now is, yeah.
well, and it kind of landing on this, go again, a little take back to our past Scott Adams episode, because I just think it was so good. Corey and I asked him, as a high net worth person and people that a lot of people know and know you have resources, how do you deal with things like pitches? How do you say no to them? And he said, it's the pain. It's the pain of deals that I thought were good, that some of I could have seen, some of I couldn't have seen, or I was just excited. He's like, but being old and experiencing pain does a lot to control yourself when you get in opportunity. So like, I don't want to like hide away from our entire audience that this, especially the first couple times you do it, like really get through a recession productively. You didn't take that advisor's advice of moving your money around. You didn't sign up for the stock newsletter and do all that. You just held through this. And I understand it's painful, but it's that pain and recovery from that pain that will equip us for the future. And guess what? It's not so painful next time. Even though your portfolio will probably be bigger, the drop will be bigger in dollar amounts, even if not as big as a percentage as other drops that you've encountered. And you'll be stronger for that one too. So I know it goes against everything. And as clients talk to us, Corey, I just wish I could give them like a really cool thing. Like, oh, all we have to do is you put a nickel under your left foot and then make sure to use your right hand mouse controller with your left hand and then randomly select stocks. It always pays off at 10% or something. I wish there was something cool and pithy we could tell people that would work. But in my nearly 25 years, and Corey, how long you been, or I'm over 25 years now.
Yeah.
And I don't know, long
North
time.
of 15.
Yeah. So
you're a little bit more than me. How about short-term agnostic, long-term optimistic? That could be a little short and pithy. So
yeah.
In general, like if it's the right time for your life and circumstances to put money in the market, then it's the right time to put money into the market. And so if you can come across from that point of view, that if you got enough cash on hand first, like that's your first step in knowing, is it the right time to put money in the market? Do I have enough cash for short-term emergencies that let me not take it out if I don't need to? So if we're in that good spot, and so this money that we're putting in is meant to be destined for the market, then be short-term agnostic, long-term optimistic. You don't have to worry about the 10% down right now because you weren't going to touch it right now anyway.
Love it. Love it. Well, with that,
it's not as cool as a nickel under your toe. I've got to try that just to see what happens.
But I'm saying I wish we had something we could tell people that would sound good. But after all these years of experience between me and Corey and Jeff and our entire team, we've found lots of cool things we can say to you as a client that might calm your nerves or make us seem smart. The problem is they don't work. They just don't work. And if they don't work, then we can't maintain our client relationships for decades at a time because we're not just keeping you busy till the next commercial break. For those of you that listen to this that are not clients of ours, let you know a secret, this podcast is for our clients. We just leave it open for everybody else to see. Because what we're efforting to do here is to equip our clients to be more effective with their money for the decades and decades to come. And I'm super thankful all the rest of you get to come along for the ride. And I hope you get a ton of value from it. But what we want you to be able to do in times like this is stay disciplined, make sure your allocation is right, make sure your expenses aren't too high on your funds, and make sure that you're being academic and you're not chasing active management. So with that, we hope this episode, like all of our episodes, has been a contribution to you being able to design and build a good life.